Welcome to yet another insightful session. This time round, we have Dennis Wakaba, who's a tax expert with experience in tax matters across the globe. He also serves as a board treasurer and is a member of ISPAC. He also holds a master's in finance from the University of Nairobi. And today we dissect the Finance Bill 2025 that was just approved and had an effective date of 1st July 2025. Dennis, please do take us through the Finance Bill 2025. What were the key highlights?
Thank you so much for having me, and really is an honor to be here this day. Looking forward to a very insightful conversation, issues of taxation and finance as well. And so we've seen quite a lot happen in the recent past, of course. We've seen, evidently businesses have been having a lot of concern with every other time you're having changes in the tax laws. It's only December where we had the Tax Laws Amendment Act. And now 6 months later, towards the end of last month, that is the month of June, we saw the president assent to the Finance Act of 2025. So then the other question you then are going to ask yourself is, are we then most likely going to expect another taxing act, another taxing bill in the parliament being introduced? Well, we can only maybe remain curious and speculative as to whether that is going to happen.
Okay. Then just walk us through what are some of the changes that you're seeing coming out from this particular bill?
This bill has been very unique in its own way because we've seen the government really shift its focus so much from introducing so many changes at a go and focus, give a lot of attention to the tax administration aspect of enhancing revenue. And we've in part seen this because in the just concluded financial year, we've seen the Revenue Authority record an increase in the tax collected and actually even surpassing its target with 6%. And nonetheless, it's not to mean really there hasn't been change with the introduction of new taxes, amendments here and there. And there are just quite a number that maybe we are going to cover in this session. And top of my mind, we have different taxation of per diems.
Okay.
And per diems, of course, we know this is the soft allowance given to employees whenever they are out there on duty, be it local, international, and they have these expenses that they are incurring. So for any amount that previously was 2,000 and above, and the employee could not account for it by way of receipts and any other evidences that they may be required to provide. So now what the Finance Act has done is that it has reviewed upward that amount to 10,000. And this, of course, is a good move because this is something that has been in force for the last, I think, 19 years. And that, of course, amount being retained to 2,000 then would mean the government is not paying attention to such changes in economy, such as the increase in cost and inflation. And therefore, the 2,000 to 10,000, having in mind that now the 10,000 that the employee will not be in a position to account for is not going to be a taxable benefit on them. And mark you, the 10,000, not unless the policy of the company does provide, you are not required by any law to provide documentation and any other evidence. Yes.
Speaking of documentation,
Yeah.
there's the application of deductions by employers at the point of taxation of employment income.
Yeah.
Is this now required or it's being thrown out?
Well, for most individual tax filings that we've seen in the past, and evidently if you ask most people who are employed, whenever they are doing the annual returns, they find themselves to be in a tax refund position whereby you find that your employer paid much more in taxes than you ought to have paid. And what has been occasioning this is because these employers have not been applying all their allowable deductions for the purposes of PAYE. And with allowable deductions, what I mean, and that is allowable deductions and reliefs, what I mean is that there are those expenses that you incur either at a personal level, or maybe there are contributions being done by the employer on your behalf. And this include contributions to a post-retirement medical scheme, a recent introduction. So to mean, if you have a post-retirement medical scheme that you're making contribution towards, that amount that you make is actually an allowable deduction, to mean the 15,000, which is the maximum amount that you can contribute, goes towards reducing the amount of your salary, your gross pay, that is subjected to tax. So like, for instance, if you think of somebody who is making 200,000 and they have 15,000 in contribution to a post-retirement scheme, the amount of pay, assuming they don't have any other deduction available to them, is going to be the 200,000 less the 15,000, which is 185. So the 185 is what is supposed to be subjected to PAYE. And of course, if you subject a lesser amount, then that translates to you paying less taxes. So the new introduction has now made it mandatory for all employers across the country to make sure that they've captured these particular contributions that employers and employees are making towards the qualifying payments and qualifying contributions that they are making. So if then the employer is found not to be doing that, then they will have a case to answer. And of course, this now calls on to all employees to make sure that they forward the contributions that they are making. And top of my mind, if maybe you would put yourself in the shoes of an employer, then you would then require your employees to make sure that they've forwarded all these details to you, so that you can capture that at the point of calculation of PAYE. Yes.
Okay, that's great. Think of, in the life cycle of an employee, we have the bit around pensions. So we have instances where the employees get deducted, the employer matches the same contribution or even higher. Do we have the finance bill impacting the pension sector and taxation around the same? Maybe you could shed some light around that.
Yes. The first and the recent introduction, or change rather, that was impacting the pension space is the Tax Laws Amendment Act of December 2024. First of all, increased the amount allowable for deductions for contributions being made to the pension scheme. So like, for instance, at that point, the maximum amount that an employee was contributing and was not taxable was 25,000. But effective December of 2024, that amount has since been increased to 30,000. So for the 30,000 that you're contributing, it is not going to be taxed. Like I had explained earlier, it will go along towards reducing the amount that the employer is subjecting to PAYE, is subjecting to tax. And we've seen the government now, I want to say, encourage savings and contribution to pension schemes, because previously what we had is that upon now contribution, an employee would approach the pension scheme and withdraw some funds, and at the point of the withdrawal, depending on some certain circumstances, like for how many years have you been in this scheme, how much have you been contributing, and how much really are you withdrawing from this pension scheme, there were exemptions at the point of the withdrawal. Like, for instance, for the first year that you're in this pension scheme, the first 60,000 was not taxable. If you've been it for, think of 10 years, the first 600,000 was not taxable. So these benefits have now been removed. They've been removed. And so the government is now restricting the access to pension schemes. And of course, there has been concerns what really is the intention here, in addition to encouraging people to save. And now the only provisions that do exist, that an employee can withdraw from the pension scheme without that amount being subjected to tax, only now 3 instances.
Mm-hmm.
You want to think of an illness.
Yeah.
If you want to assess your pension because you have an illness that requires a lot of funds for treating and all that. If you've obtained the age of retirement, and the age of retirement is as defined by that specific pension scheme.
Okay.
Yes. And thirdly, it is, we've talked of illness, we've talked of retirement, and thirdly, if you've been in this pension scheme for a period of 20 years. So now, if the earlier of the 3 occasions, so if you've been in pension scheme for 20 years or more, then you are in a position to qualify for withdrawing from this particular pension scheme tax-free. And maybe as we close on the issue of the pension, it's also to note that there's a positive move whereby the government has actually extended the exemption from these schemes, the contributions made in form of gratuity. Like, for instance, you've been in employment for quite a number of years, and you're being paid by your employer a certain fee for the years of service that you've served. So if then what the government is saying is this contribution is channeled now to a private scheme. Initially, this was only allowed to, the only exemption that existed was to a public scheme. So now, if you're withdrawing these contributions that are being channeled directly to a private scheme, in addition to what existed previously, that was the limitation had not been granted to the pension to the private schemes. So now, at the point of the withdrawal for the contribution in gratuity from a private scheme, then that does qualify to be exempted from tax. Yes.
Okay. In terms of, I know right now there's so much talk around the Talanta Stadium, there's CHAN, there's AFCON coming next year. How did the government react to matters sporting within the finance bill? Are there new taxes? Have we abolished the ones that were there? Just walk us through that.
Interesting. Given in mind, of course, it's a very hot debate right now. And of course, the amount that the government is spending to build that particular facility has been in the airways for quite some time now. And we've seen quite an interesting introduction in the Finance Act. And, even the president has been alluding to the fact that one of the agendas of the bottom-up economic transformation agenda, is to promote sporting activities. And it was a little bit contradicting with the provision that was existing in the Finance Bill, which has since been changed in the Finance Act, because in the Finance Act, what we have is that for any contributions being made to construction of a sporting infrastructure that is on a public land, you want to note that, on a public land. Of course, that would mean that that particular facility is of a public nature. So for any contribution that a taxpayer makes towards the construction of a sporting facility that is contained in a public land, then it is an allowable deduction for tax purposes. It goes along towards reducing your tax payable. And this is in addition to, for all contributions that taxpayers make towards the construction of sporting facilities, for such kind of contribution to qualify as a deduction, there was, and still actually does exist, there is the requirement to seek the CS approval. Of course, if this is happening in a private land, and it could be maybe a private sporting activity that is also inviting the members of public to make use of that particular facility. So this extension has now been granted, whereby there's not going to be that requirement of approval by the CS respective for sports activities to make that approval for such kind of a contribution to go towards reducing your tax payable.
So this
Yes.
means, in essence, opening up that space more.
Yes, opening
Okay.
up that space more. It's government inviting the private players, the
To
private
the table.
taxpayers to the table and to making contributions towards its initiative. Yes.
Okay.
Yeah.
There's a lot of affordable housing. We know housing levy and the reactions it's elicited among ourselves.
Yeah.
Uh, People are building houses. Is it something that has been covered within the act itself? Paint a picture of that.
Okay. Yeah, absolutely. And this also was a very hot topic at that time because there's a very special provision that exists in the Income Tax Act whereby if you're constructing a certain number of houses, then you are taxed at a lower rate, at a preferential rate of if other companies are being taxed in the uniform rate of 30%, which is the corporate tax rate, then for the active players in this industry, building a lot of houses, they were being taxed at a reduced rate of 15%. So in the finance bill, actually, at one point sought to remove that special provision, but it's not been enacted in the act. It was removed. And of course, it's a bit reason to remove such kind of a provision given the effort that you're seeing the government making towards the construction of the houses, the affordable housing. And this has now further been entrenched to the private individuals, the private taxpayers who are constructing houses. So for any taxpayer who has a mortgage, where they have a mortgage and they are building a house, they are constructing a house, the first house, we say the first house for occupation, the interest that they are making towards the settlement of their mortgage is now an allowable deduction to a maximum of 360,000 per annum. And there was an earlier restriction actually, whereby the mortgage contribution, the payment in terms of interest for the mortgage that you're paying, was only allowed for the instances where the taxpayer is improving their house, or where they are acquiring at the point of acquisition. So this has now been extended to those people who are constructing their own houses. Of course, now, like you mentioned, it's government saying that we want you to be building house and to enjoy tax benefits like others who are in a position to buy ready-made houses.
Okay,
Yes.
interesting.
Yeah.
Now, think of right now there's so much talk around employment among the youth. We are moving towards owning businesses, entrepreneurship, and all that. So for businesses, talk around some are making profits, some make losses and losses for years. What's the provision like in terms of the losses they're allowed to carry to the next year and the next? I know we've had something around that space, but just clarify around what does the act maintain or want to be done going forward?
Yes. So what has been happening is that taxpayers had been allowed to carry forward losses indefinitely. Where, like, for instance, if you are a startup whereby you're committing a lot of funds initially in starting your business, in marketing your business, in buying, even in constructing maybe your business premise. If, like, for instance, you're in the construction industry, think of the capital intensive businesses, the construction, the manufacturing, and all that. So what has been happening is that once now you start doing business and in the first year you make a loss, what happens is that if you make a profit in the next year, the amount of tax that you're going to pay in the second year ideally should be reduced by the loss that you made in the previous year. So if you made a loss of 100 million in the first year, and then the second year you made a profit of 10 million, it is to mean you have 190 million to utilize for the next couple of years before now maybe you even break even. So what now the Finance Act then has done is that it has limited the number of years that taxpayers can carry forward these losses. So if you continuously be in a loss position for 5 years, then for you to continue utilizing these losses to offset your profits in the subsequent years, you have to make an application for the extension of this utilization for another maximum period of 5 years. And of course, for big businesses, really, the construction industry, like I mentioned, the manufacturing industry, the really capital intensive industries and taxpayers, they are going to be heavily affected by this, because at the lapse of 10 years, that is after now making application for the after the lapse of the 5 years, then your losses then are going to be no longer be utilized. And of course, there's a motive behind this, whereby the commissioner and the revenue authority feel that there are people who, according to their tax filings and book, the book preparation and all that, they say they are in a loss only at the place of the preparation of the books, and therefore after the 5 years, then these taxpayers who are in a continuous loss position will be making an application, and of course that now gives the commissioner the reason to want to look into your numbers and justify themselves that really you've not yet broken even, and you stand to continue benefiting carrying forward your losses. Yes.
You've actually covered a bit that I wanted to ask on.
Yeah.
Is the government indirectly telling us, I expect you to break even in 5 to 10 years? Is it a realistic expectation for the businesses within?
It's not realistic, really. If really we are to say what really happens in the real world, well, the government may be saying we want you to be breaking even as soon as possible, but also maybe have some policy change that that facilitates businesses to have a very sooner turnaround. But also, just maybe to take you back, you may remember there was a time we had the minimum tax, which was being levied on all taxpayers. If you're in a loss position, if you're in a profit position, then you had been required to pay a 1% of your revenue, of your sales. Yeah. So what the government at that point was saying is that the 1% that you've paid is an installment tax, to mean, is an advance tax rather, to mean that the 1% that you're paying at that point, you would utilize that now when you're filing your annual returns. And of course, this issue went to the court. That provision went to the court, found not to be unconstitutional, and now it has been removed in the Act altogether. The Finance Act has actually repealed that particular provision, to mean most likely we are not going to see it make a return in the near future. Yes.
Okay.
Yeah.
Okay. That's interesting. Now, there's so much talk around pending bills. It's always been a headache for us as Kenyans. People trying to do business with government, trying to make ends meet, but we know what happens or what has been happening. So you bid for your tender, there's money that is supposed to be paid after fulfilling the obligation of providing the services to government.
Yeah.
Are there changes around that space? What should we expect to see going forward?
Absolutely, there has been a change. There has been a lot of change in terms of doing the taxpayers doing business with the government. You've seen the e-procurement being put in place with effect from 1 July. We've also seen FMIs being given a lot of attention. And the government still feels that we need to close into these people who are doing business with the government, whereby for all supplies, be it in goods and services, these payments to these particular individuals who are doing business with the government, they are going to be taxed a withholding tax. Those payments are going to be subjected to a withholding tax of 0.5% for the Kenyan citizens, to call them so, but this is for residents. And the purpose of withholding tax is to bring into view, really, you would think, to bring into visibility the income that a taxpayer is earning. Because at the point of filing your annual returns,
Yeah.
for any income that has been subjected to withholding tax, it must be declared. So if you've done the business with the government, they've said you've supplied us goods worth 100 million net,